Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast. And I have a returning guest, and I think it's his fifth time now. So he's a regular on the show. Krishan Gopaul, who's the senior research analyst at the World Gold Council, who are authority on gold. They explore unique gold market and industry research, producing analysts, commentary and insights on the precious metal. To improve the understanding, access and trust in the yellow metal. Krishan has been with the World Gold Council for over 14 years now, and he's here today to give us an update on the latest gold demand trends report for the first quarter of this year, some of the main drivers of gold at the moment, investor demand and activities of the central banks, and obviously a lot more. I want to give a shout out to our sponsor, Torcroft, who are leaders in property risk management in the mining industry and have been since 1992. They offer insurance risk surveys, construction risk reviews, and asset criticality assessments and more. They work across 600 sites globally, and they support all areas of mining and mineral extraction. So if you're looking for any property and insurance risk management services in the mining industry, then please visit their website at www.hawcroft.com, and all the details are in the show notes. Krishan, welcome to the podcast. How you doing?
Not too bad, thank you, Rob. Thank you for having me back.
Yeah, and obviously since we last spoke, you mentioned offline you're a new dad as well, so congratulations on that.
Thank you very much. Yeah, it's been an adjustment, and I haven't had much sleep since, but we continue.
Yeah, certainly. So I wonder if you can just give us a brief introduction to yourself. As I mentioned, you've been on here about 5 times, and I encourage any of our listeners to go back to probably some of the more recent podcasts that we did and see obviously what changes have happened. But I just want to give us a quick overview of yourself and a little bit about your career and what you do within the World Gold Council.
Yeah, sure. It's always a pleasure to speak to you and your audience about gold. So yeah, myself, as you say, I've been at the World Gold Council within the research team for over 14 years now. And so I've seen a lot of highs and a lot of lows and a lot in between. And so, as you say, the World Gold Council is there to really kind of educate kind of market participants, investors in particular, as to the strengths of gold as an investment, but kind of give a broader understanding of the market as a whole, in order to kind of give people that knowledge and that insight that they need in order to make informed decisions. So it's always very interesting when we look at what's happening in the gold market. It's been incredibly interesting recently. So look forward to getting into some of the nitty gritty.
So I just wondering if you can just give us a short summary of the World Gold Council's latest report on gold demand trends for the first quarter of 2025.
Yeah, I'm sure your audience are very familiar with all the headlines that gold has been making recently. Obviously, that's been kind of led by the incredible rise in the gold price that we've seen that kind of took off from last year and was really accelerated as we moved into this year. We saw 40 new record highs last year. We've seen 20 in the first quarter, and then another further 5 record highs as we moved into Q2. So again, remarkable price action, and that had a really interesting impact on the gold market as a whole, but in the on the particular different sectors as well. They will react differently. So for example, overall we saw total gold demand in the first quarter that was up 1% to 1,206 tons. Now that was the highest first quarter of gold demand that we have seen since 2016. So again, a really impressive total that we've seen, in response to the gold price and the factors that we'll come on to talk about. And if you look at some of those different sectors, as we talked about, behave differently. Investment really stood out, particularly gold ETFs, as an area of strong demand. obviously, I think a lot of the factors that, again, we'll touch upon are quite familiar with your audience, that are kind of the geopolitical landscape, the kind of the macroeconomic landscape, and concerns over the outlook, were kind of leading factors for that. Central banks, you mentioned it in your intro, yet they continue to be a huge source of demand for gold, and again, they were in Q1, and so that's been a long-standing trend that kind of is providing a level of support to gold. And then if we look at the more consumer facing elements, your jewelry, for example, that tends to be a little more price sensitive. Now, what we saw, obviously, we saw that come under pressure because of the higher gold prices, as to be expected. That's kind of a well-established relationship. That obviously, as the price got higher, affordability was impacted. So again, the kind of the overall picture is kind of nuanced. There are different dynamics at play, but it makes for an overall very, very interesting story.
What are some of the main drivers for obviously gold demand and record high gold prices for 2025? Where are you seeing the main drivers for gold?
Yeah, it's a good question. I think we can broadly break things up into two categories. There is the kind of macroeconomic picture, and then there's the geopolitical picture, and sometimes they kind of overlap. So if you look at the kind of the macroeconomic picture, certainly what we've been seeing for some time now is the central banks kind of battling against the kind of the inflation problems that we've had in the last few years since COVID. And obviously those concerns, while have kind of come down or reduced, it's certainly something that was still a question mark coming into this year. How will central banks behave? What will it mean for monetary policy, expectations around interest rates? And all of that plays into the kind of what drives gold. Interest rates, and particularly in the US, are obviously a key factor. Now, obviously, if you look at what's happened since, there's been a lot of volatility in the markets. We've continued to see that question mark around central bank policy and what that may mean, constantly being revised. We've had what we saw in the first quarter as well was the enacting of the US tariffs. Huge news globally, and obviously, while tariffs weren't applied to gold directly, it did create an overall market impact. We saw greater levels of volatility. We saw the dollar sell off. We saw kind of treasury sell off as well. So again, that plays a role in how gold will perform, because it doesn't perform in isolation. It performs in the context of how other assets are performing too. And I should also mention stocks too. They took a hit as well off the back of that. So I think if we look at what's happening with investment demand, certainly you can see from a macroeconomic standpoint, there are good reasons why investors moved into gold, or moved more so into gold in Q1, because of those reasons. The kind of the volatility itself driving things, but then that leads on to question marks about the future as well, and expectations. So things like US tariffs and trade deals and kind of the upheaval that's causing, that's not something that will necessarily be solved in a matter of days or weeks. This could take months and years. So again, there's real question marks around what the future may bring. And again, in those times of heightened uncertainty, that really plays to gold's strengths. People see it as a safe haven asset, something that to go to when other assets are looking dicey, and that's certainly been the case in Q1. And now on top of that, if you look at, as we said, the second category, which is geopolitical risk kind of layered on top, then yeah, again, things kind of look no less uncertain. We still have, unfortunately, conflicts around the world and tensions between nations and geographies. So and again, the kind of the things like tariffs and stuff that kind of straddle both, again, exacerbate a kind of the existing level of uncertainty we've had to really compound things. So again, it's led to that kind of wave of investment that we saw. Now that was both bar on coin and ETF, particularly ETF. We saw huge amounts of inflows into those products from all regions. So North America, Europe, Asia, and elsewhere. So while North America tends to be the biggest funds and the most liquids, where we see the biggest flows, that was certainly true. But the real standout was Asia. We actually saw incredible interest from particularly Chinese investors in gold ETFs. And I think the gold ETFs, at least that we track, are physically backed. So certainly that shows that the interest in gold, particularly physical gold, is something that kind of is universal. That the concerns that we saw weren't specific to one geography, weren't specific necessarily to one cohort of investor. They were broad based. It was very much a case of investors saw this level of uncertainty ramp up, question marks about what may come, and therefore looking for assets which will perform well. And gold certainly did. And that in itself, that rally, that big pickup in gold price that we saw, that in itself helped drive some momentum investing as well. So it really kind of fed the whole overall narrative that actually, in times of crisis, gold tends to perform well, and it certainly did in Q1.
Obviously, there's obviously a lot of institutional investment in gold. Have you seen a lot of retail investor demand, and has that, I suppose, increased as you've seen the gold price increase?
Yeah, absolutely. So that's the other side of the investment picture that we talk about in the report. So you have ETFs on one side, and then you have what we term retail investment, or bar and coin. That typically captures, products like bars and coins that are around 1 kilogram or less, so tend to be on the smaller side. And certainly what we saw is we saw very solid demand there too. That was up 3% year on year in the first quarter. So again, we're continuing to see a level of interest, not just from the kind of sophisticated professional investment community, but also from retail investors, people like you and I, kind of looking to kind of increase their exposure to gold. And again, many of the reasons that kind of we cite in the report for that increase in that kind of bar and coin demand space are very similar to the ETF space. We certainly see that kind of the level of uncertainty kind of pick up. That was reported widely. You couldn't pick up a newspaper without seeing some bad news somewhere. And so that again feeds investor concern, whether it's at the retail level or the institutional level. And again, that kind of reassessment of what assets would I want to be holding in these times. And again, that played, as I said, to gold's strengths. And certainly what we continue to see is that again, it's not necessarily something that is specific to any one geography. We did certainly see greater levels of bar and coin investment in, say, Eastern markets. So China saw its second highest quarter of bar and coin demand on record, and our records go back to the year 2000. So that's a good chunk of time. So again, that investment motive that we've seen really came to the fore in certain markets, but it was relatively broad based. There were some differences, and again, that's just investor behavior that we try and capture too, because these things are never kind of like a perfect relationship. But certainly, again, at a global level, we saw the kind of the overall investment picture, whether it's ETFs or bar and coin, remain very, very strong in the first quarter.
And who's actually buying the gold ETFs, and what is behind, I suppose, the acceleration of inflows into funds around the world?
So ETF investors tend to be institutional and retail. It's a bit of a mixture. We don't have the perfect clarity on who all the investors are, the full breakdown. But certainly what we do see is that it comes from both the kind of the more sophisticated end and the kind of the more retail end who might work with advisors, for example. And again, as I said, that type of investor or those types of investors we see again in all geographies. So whether that's in Western markets or Eastern markets, the picture tended to be the same in Q1, that there was just very much a kind of a one directional move into gold that we've continued to see into Q2.
And how about central bank demands? Who are the main purchasers, and what's driving the slowdown in the pace of central bank gold buying?
Yeah, so we've certainly seen a long-standing trend. So central banks became net buyers on an annual basis, at least in 2010. So we've now seen 15 years of central bank buying, and this will be the 16th year if they continue to do so. And certainly in Q1, we can see that trend of buying has certainly continued, and not just the trend of buying. Anyone who's read our report will have seen in the last 3 years, central banks bought an incredible amount of gold, 1,000 tons in each year, and that's up from an average of 400 to 500 tons in the years before that. Now, what we saw in Q1 is the kind of the pace from the last 3 years of colossal buying has persisted into Q1. And so the level of buying, that 244 tons that we spoke about, is kind of in line with that range that we've seen over the last 3 years. So again, remains very, very healthy. You're absolutely right. On a quarter-on-quarter basis, we did see a slight slowdown. But I think if you take it in the broader context, central bank buying still remains very, very robust. And again, it's not necessarily something that we have expectations will change anytime soon. In terms of the actual buyers, a bit like the long-term trend I've spoken about, it tends to come from the emerging market central banks. Historically, they tend to own less gold than their developed market counterparts, either in absolute volume basis or as a percentage of their total reserves. And so some of the people that we've seen, or some of the banks that we've seen buying are people like the National Bank of Poland. They've bought a significant amount. They bought about 40 or 50 tons in the first quarter. The People's Bank of China, we saw continued buying from at more modest levels, but they continued to buy. A sovereign wealth fund that we track, the State Oil Fund of Azerbaijan, they were a healthy buyer in the quarter. And again, the overall balance, because we saw net buying, was that the buying from those emerging markets that we saw comfortably outweighed any of the selling from the emerging markets that was also reported.
Yeah. If we look at the gold production from the miners, is there any particular countries or jurisdictions or even continents that are producing or had an increase in gold production since, I suppose, 2025 and going through this year?
Yes, I mean, in the report we mentioned that mine production for the first quarter at least was 856 tons, and that was really a fraction above the first quarter record that we saw back in 2016. So again, a very strong number and a new record just. Some of the increases that we saw from jurisdictions that contribute to that were kind of like, can name a few, like Chile, Ghana, Canada, and a lot of those were driven by kind of ramp ups in kind of projects that had already been online or just come online, or expansion of existing projects. So again, there was a mixture of contributing factors based on the geography that you were in. And something that obviously we were talking about offline was that gold price increase and what that's done to producer margins. So they're generating incredibly healthy cash flows at the moment. We've seen costs go up, and they've been going up for a few years now. But certainly the rapid increase in the gold price has kept things very relatively healthy for them. So again, that's all led to a kind of an overall relatively positive picture for the mining industry, at least in Q1. And again, there was a number of different areas where we saw the kind of the pickup. It wasn't any one particular jurisdiction, and that's the benefit of gold supply. We talk about it often, is to say it's incredibly geographically diversified, which means that actually you're less likely to get those supply shocks. If one jurisdiction or a project were taken offline, the market would be able to accommodate that. Would be able to handle that, and it's proven it time and time again, COVID being a recent example. So yeah, overall, I think it looked like a positive picture for mine production in Q1.
Turning to sort of retail gold demand, why has the demand for bars and coins fallen in the US but risen in India and China?
Yeah, so we touched upon this in the last answer on bar and coin, but certainly I think if we dig deeper, you're absolutely right. There was a difference in the kind of the investor response that we saw to the bar and coin demand. So if you look at the West, we actually did see a slight decline in the US. And while we saw a pickup in European bar and coin demand, it was from an incredibly low level. So, kind of a more modest response. But in the US in particular, one of the things that we note in the report is historically, bar and coin demand tends to do slightly less well in the US during Republican presidencies. And obviously Donald Trump won the election in November and has come into power as of January. So this is something that we have seen before, this kind of back off from US investors into the bar and coin space. And I think, some of the reasons that we can mention for that is just that coming into the quarter and certainly into the Trump presidency, I think there was optimism in terms of economic growth. I think there was optimism about more market-friendly policies, deregulation, kind of things that are likely to promote kind of growth in the economy. Now that's proven to be a little less straightforward. But I think that sentiment during or coming into the Republican presidency that we've got currently is a reason why investors maybe felt more optimistic, particularly in the US, as to the economic outlook for the country, and so maybe felt there was less need to kind of rush into gold that you saw elsewhere. So as you mentioned, the Eastern markets like China, for example, even India as well, their perception was different. Obviously, the advent of the gold, the US tariffs, particularly against China, and that kind of this brewing trade war and the tensions that we've got from that is obviously viewed very differently in China, and again against the backdrop of maybe a slightly weaker economy that again might get hit further based on those tariffs. That obviously initiates or produces a different response from Chinese investors than it would US. So again, there is that divergence that we did see in the bar on coin. Even though the overall number was strong, there were differences again that are really interesting to pick into and try and understand how those different investors will behave. Whereas if you look at it contrastingly, as we've spoken about, to the ETFs, that was pretty much universal. Investors were kind of piling into ETFs in all regions, whereas the bar on coin was a slightly different story.
We're obviously in the UK. How is the demand for bars, coins, and even ETFs here in the UK compared to, say, US, India, or China? Just wonder if you can comment on that.
So the UK tends to be a smaller market. It's not a major one. For bars and coins, I should add. In the UK, we did see bar and coin investment boosted by the kind of budget changes that we saw last year and kind of making gold capital gains tax compliant. And so the thresholds obviously changed in terms of where that needs to be paid. So that again was a kind of a boost. But again, the UK tends to be, at least on the bar and coin side, a relatively small market. On the ETF side, the picture is slightly different. UK ETFs or gold-backed ETFs tend to be rather large, kind of not quite as comparable as the US, but certainly within Europe, it's a major market for gold ETF demand. And again, we saw healthy investment there, like we did elsewhere. Certainly, again, because there are so many funds in the UK and of good size, that it's often that you see that any moves in ETFs more broadly will kind of be disproportionately accounted for by the US, by the UK, Germany, for example, and then emerging now China, for example. But yeah, so overall it was a relatively positive picture for investment demand broadly in the UK, whether that's bar on coin or ETF.
Obviously, we've been speaking about coins, bars, and ETFs. What about jewellery and what the demand for, how's that fared amongst obviously record high prices this year?
Yeah, so unsurprisingly, jewelry demand was kind of under pressure in the first quarter. So jewelry consumption, as we measure it in tons, was down 21% year on year. And as I said, somewhat unsurprising given the rapid increase in price that we've seen, and the impact on affordability that will have. So historically, jewelry demand is strongly related to what the gold price does. When it goes up, you tend to see jewelry demand fall back as investors kind of consumers tend to buy less of it. And that's certainly what we saw in the first quarter. If you look at it kind of broadly, there is a different picture when you look at value. So when you compare gold demand on a tonnage basis, as we said, that was hit pretty hard. But if you look at it on a value basis, so kind of looking at what consumers spend on gold jewelry, that was a contrasting picture. That actually went up in the quarter. That was up about 40% year on year. So we're actually seeing consumers spend more on gold jewelry, even if the overall volume of gold jewelry is less. And that was almost a universal outcome in all markets except China, and that's a really interesting development. The fact that there's something that's so widespread that jewelry demand, in value terms at least, was higher everywhere. And I think part of that, in certain markets especially, speaks to the quasi investment kind of angle that jewelry sometimes plays. So, kind of more plain high caratage gold can serve as an investment as well as a kind of a piece of jewelry. And I certainly think we saw that there. And that kind of links to what we've already spoken about in the investment space and that concern driving that investment. I think some of that may have overlapped into jewelry too. That it's an asset worth holding, whether it's in the form of bars and coins or kind of plain or high caratage jewelry. What I would also say is another factor that's important for gold jewelry is income. And certainly, obviously, as people tend to feel wealthier, they may have more disposable income, and then that can go to products such as gold jewelry. Now, obviously, there are big question marks about economic growth, kind of incomes. There's still kind of higher levels of inflation around the world. So we're still tending to see kind of consumers kind of being in somewhat of a cost of living crisis. They're still finding their pockets pinched. And so, again, that can have an impact on the levels of gold jewelry that we've seen. And then we've kind of seen that over the last several quarters too, where that kind of pressure that people feel in their pockets has kind of impacted the overall level of jewelry demand too.
And lastly, just wonder if you can just tell us about the World Gold Council's outlook for the rest of the year, and what trends should we be looking out for?
So this is always one of the hardest parts of the report to write because, obviously we don't have a crystal ball, and obviously the incredible volatility we mentioned earlier in Q1 makes it even more difficult to try and predict what may happen. But if we rely on kind of well-established relationships, we tend to have a fairly confident position on this. So if you look at the kind of the macroeconomic and geopolitical backdrop that we've already spoken about, I think that lends itself to kind of maybe continued investment demand, both on the ETF and the bond coin space. So obviously we don't know what's going to come in terms of tariffs. We're currently in a pause, but it's kind of set in motion this kind of heightened level of uncertainty, which will be difficult to kind of dispel from the market. So I think it's likely that at least for the upcoming quarters, we should see still healthy gold investment demand. For central banks, I think we continue to see gold buying. I think, we haven't got much data beyond Q1 yet, but I think, these tend to be strategic buyers. They're not kind of investors who kind of play the markets from day to day. So it's likely that obviously the long-standing trend since 2010 that we've seen and into early 2025 is likely to persist. It will be interesting. It's always difficult to try and predict the amount that central banks will buy. I think coming into this year, we felt that it would remain strong, comparable to what we've seen in the last couple of years. Again, that remains to be seen in terms of the absolute volume, but certainly in terms of being continued buyers, I think for central banks that's likely to be the case. And on the consumer side, I think given where the price is, remains at elevated levels. I mean, it got close to 3,500. It's now back to about 3,300, I believe. Those are still relatively elevated levels, and not just in dollars. It's elevated in all major currencies, and so while that can be positive for investment demand, if people see the rally going higher, their expectations shift, and so they might want to hold off selling for hope that they might sell at higher prices later, or just want to kind of hold on to that asset because they feel it's the best thing to hold in these times. But certainly, I think if you look at jewelry, with the high prices, it's likely to stay under pressure given where we are. Should prices come down, then the picture may shift, but at the moment the fundamental picture is certainly one that's supportive of gold.
Krishan, really appreciate your time. Thank you for giving us an update on the gold market and tell us about the gold trends report for the first quarter of 2025. If our audience wants to access the report, how can they go about doing that?
Yeah, so our report, the Gold Demand Trends for the first quarter of this year, is available on our website, goldhub.com. But there you'll also find not just that report, you will find all of our research and insight, as well as all of the data that we're able to give to people. It's free to access. You just sign up, create an account, and then you have access. So I would highly encourage anyone who's interested in anything that we've spoken about today, or is interested in gold in general and the gold market, please definitely come and visit us at goldhub.com.
Yeah, certainly, and I'll include those in show notes accompanies episode. So thank you for coming on the podcast again. Hopefully you can come on later on in the year and give us some more updates during 2025, which I expect to hear even better, higher gold price, should I say, hopefully over the coming months. So it'd be good for you to come on the podcast later on in the year.
Thank you very much for having me, Rob.
Yes, no worries. Thank you for listening. I hope you enjoyed that episode. Please share this episode. Obviously talking about gold, it is in the market a lot more, or in the news a lot more now. So if you're unfamiliar with gold, maybe it'd be good to listen to this episode and also share it, and obviously visit the World Gold Council's website as well for more information and a better understanding of what actually gold represents. So thank you for listening. Hope you enjoyed that episode, and as always, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes, and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.